What is up, YouTube? This is The Working Investor. In this video, I want to talk about my option play. And I do have high yield dividend ETFs. I use them as a baseline to get a baseline income. But on top of it, I like to do my own option strategies. I use the high yield dividend ETFs to give me at least try to get me, because I don't have enough time to trade so much. And it gives me it gives me some baselines. So I'm going to talk about a trade that I put on Thursday. I took it off on Friday. And would you imagine that you got an 84% annualized return with zero NAV erosion? You got all your money back and you have the dividends or the premium, if you want to call it, premium. And not only that, you don't have market risk for the entire week. You only have market risk because the trade was only on for one day. I only had market risk for one day. I like to put these trades on Monday to Thursday, somewhere in that range, and they expire every single Friday. And basically, you're reducing your weekend market risk, and you're putting on the trade Monday, taking it off on Friday, or you put it on, sometime between Monday and Thursday. So you have less than a week of market risk. Reducing market risk, increasing, no NAV erosion, pure premium. That's the benefit of doing sometimes things yourself. But of course, there are some inherent risks. You don't see the TNA. So what I'm doing is it's basically a triple leverage ETF on the Russell 2000. I know that's kind of a mouthful. So it has triple the volatility, hence it has triple the premium. So you have triple premium on an entire index. And also, I did a in the money covered strangle with a in the money covered call. So I know it's a mouthful. I'll break it down for you. So basically, my trade is as follows, and it's in yellow. I'm sorry about the spreadsheet, but I have to show you this. So basically, I put the trade on the 22nd. It's expiring on the 23rd. 1 day to expiration for both sides of the trade. So at the time I put on the cash secure put, TNA was trading at $42 a share. It was a 40.5 cash secure put. I forgot what the delta was. I think it was less than. I think it was less than 0.3. So I put up $4,050 in collateral, made $48, took it off for $10 the next day, $38 total. I know $38 doesn't sound like a lot, but if you look at the ratio, making that in a week, only on that comes out to be a 0.94% return in a week. I mean, if you think about capital efficiency, I have 10 grand, let's say, worth of Roundhill funds, and sometimes I make for proportionally, this is an amazing return. This is an amazing return. And actually, right here, the Roundhill fund, actually, one of them gave me 1.1% and 0.9, so that's not bad. But that's only one part of the trade. Part two of the trade was I actually bought 100 shares when it was trading at 41.2. So I spent, and I sold a $41 covered call. So it's an in-the-money covered call. In the money covered call, because $20 in the money, or 20 cents per share. So I put up $4,120 in capital. I received $115 in premium, but I have to take off $20 because it's in the money by $20. $20 is intrinsic value, INT value, is what I wrote down. So actually my net return and it is $95. And of course, TNA went up and expired worthless, and I got my shares called away, which is perfect. I wanted that, and I walked away with $133 on $8,170, which comes out to be a 1.6% total return, about a 1.6% total return in like 1 day. But because I could only put this trade on once every, this is my math. Let me show you my math. So it was 38 on the put side plus 95 on the call side is 133 divided by 8,170, because that's how much capital I had to put up. That comes out to be, 1.62% return. If I were to repeat that for 52 weeks of the year, it's about 84% annualized return. Of course, things could vary. So somewhere between my goal, like I said, on each side is about 1% return at least on each side. So, roughly. So this comes out to be about 84%, or it's pretty good. And I have all my cash back, and I'm ready to I can do other strategies during the week. So basically, why do I do in the money cover call? Why? Right? So let's say right now, let's do an example. So let's say August 30th, coming up this Friday, right? So let's say you bought 100 shares and you immediately want to sell in the money cover call, right? And you can see here the share price of TNA, which is the triple leverage Russell 2000. It's trading at $44.89. So you immediately buy it, immediately sell it in the money cover call, and you're going to go one strike down. Why don't I go deeper down? Because if you study options, you'll notice that the most extrinsic value you get is at the money. So if you go far deep, in or out of the money, you don't get that much extrinsic value. So that's what I learned from studying options. So basically, I would go for the 44 strike price, right? You can go a little lower, but you don't want to go way too far because sometimes you don't really get much return. So why am I doing this? So even though I'm getting $1.80 per share times 100 shares, which is $180, I'm not really keeping $180 because I bought it for $44.89, and it's $89 in the money. So $89 is just to break even. Whatever's excess of $89, which is $91, right? Because 91 plus 89 is 180 or 1.80. So that's my profit. My profit will be $91, but $91 in less than, that's about a 2% return just from the in the money covered call in less than a week. Because I like to put these trades on like Monday to Thursday. Of course, things will, because we're going to be next week, there will probably be a little less because of less time value in it. So why do I do it? Because it does give me, I want my shares called away. I only bought these shares for the premium. I do want these shares called away. But I also want to give myself a little bit of downside protection, because what if the shares go down, right? So right now it's trading at $44.89. So this gives me, this premium of $180 for 100 shares gives me $180 of buffer, or I can allow the stock to drop $1.80. So basically, and I'll still be like made even. So if it's trading at 44.89, you subtract 1.8, so I can have the stock go all the way down to 43.09, let's say, right? And let's say it went down to 43.09, and obviously my shares will not get called away. I'm going to be stuck holding these shares. At least I'm still made even. I have the buffer all the way down to 43.09. And I'm still not in the red. Only if it goes further below that, then I would be in the red. Yes, and you can see here the 43 call price. So exactly. Yeah. So let's say I did buy call 43. Yeah. So it does give me some downside protection. It does give me downside protection. If I were to do, let's say, the 43, So let's say it's 230. So let's say 43 plus 2.3 is 45.3, right? So basically, but if I subtract 44.89, that would only be 41 cents per share. So I would get $41, which is okay, but that would give me more downside protection because I could have this, because I got $2.30, right? So if I paid $44.89, I take away $2.30, I can get the price of the stock to go all the way down to $42.59, and that would only if it goes below $42.59, then, or 42.59 for one share, then I would be in the red. So that's one of the reasons why I like to do in the money cover call, because if the purpose is not to keep the shares, or the purpose for in the money cover call is to get rid of the shares, then it gives me a little bit of downside protection, because if I'm worried about the stock going down. Obviously, if the stock stays neutral or goes up, I'm totally fine. I'm totally good. Sometimes I think about if I should do in the money cover call, because most of the time there's something called put skews. Most underlyings, there's more fear for the downside than the upside. So sometimes I think to myself if this is the right strategy because of put skew. But I use this strategy because of the strangle component, because I like to have double the premium. So that's why I use it. But let's say, for example, you do sell put. Let's go for like a 0.275 delta. You see you're getting 67 cents, of premium, or $67 of premium. But if you go to sell call and you're looking for like a 0.3 delta here, 0.274, almost the same, you're getting 60 cents. So it's a little bit, if you notice, a little bit of put skew, a little more fear on the downside. So sometimes a cash secure put delta to delta could be worth it. But what I do is I attach the in the money covered call with the cash secure put, basically going crazy a little bit over here. Anyways, I hope I didn't complicate you guys. If you guys want me to break it down a little further, let me know. Anyways, this is the Working Investor over and out, and I have a lot of developments coming up with different strategies. I hope all is well.